I want to start with something that sounds almost impossible, and yet it has happened over and over, right in front of everyone, in the full light of day. The people who are supposed to be the smartest sellers on earth, the most sophisticated, the best informed, the ones with the biggest desks and the finest research, have a habit of selling at the exact wrong moment. Not close to the bottom. And they do it publicly, with press releases and confident explanations, while ordinary savers who felt embarrassed for holding on turned out to be right all along. If you are holding silver right now, and you have watched it get knocked around, and some quiet voice in the back of your head has been whispering that maybe you got this one wrong, maybe you missed your chance to get out clean, then I need you to sit with me for the next 20 minutes, because that voice is not yours. That voice was put there. And the same feeling you are having right now is the exact feeling that historically has shown up at the moment the sophisticated money was busy handing its metal to the patient. By the end of this, you're going to understand who is really on the other side of your fear and why the loudest, most credentialed seller is so often the one marking the low. Here is the first thing I want you to chew on, and it is not a price, it is a pattern. Watch what gold did through the roughest stretch of this silver correction. Gold barely moved. It sat there, steady, almost bored, while silver did all the heavy swinging, all the dropping, all the drama. And when silver falls hard while gold holds its ground, something specific has happened. Silver just got cheaper relative to gold than it already was. The gap between them widened. That gap is not noise. That gap is the whole story. And I'm going to show you why the people who understand it are quietly grateful every time the crowd panics. Now, let me take you back to 1999, because this is the true story this entire video is built on. And once you see it, you will never look at a headline the same way again. The seller in this story is not a reckless speculator. It is not some cowboy who got over his skis. It is the United Kingdom, the British government, one of the oldest, most respected financial establishments on the planet, sitting on a hoard of gold accumulated across centuries of empire. And they decided to sell about half of it. Here is the part that still makes seasoned investors wince. They did not just sell, they announced it first. They told the entire world in advance that they were going to auction off a large share of the nation's gold reserves. Think about what that does. If you are going to sell a huge amount of anything, the last thing on earth you do is warn every buyer that a flood of supply is coming, because they will simply step back, fold their arms, and wait for your selling to push the price down before they lift a finger. That is exactly what happened. The pre-announcement drove the price lower before a single ounce was even sold, and into that self-inflicted weakness, the British Treasury sold. They sold near what turned out to be the lowest gold prices in a generation. Within a couple of years, gold turned and began one of the greatest bull markets in modern financial history, climbing for a decade, multiplying many times over. The metal they dumped for next to nothing went on to become one of the best performing assets of the era. To this day, in the trade, that bottom has a nickname. They call it Brown's Bottom. The most sophisticated seller on earth, selling the exact low, in public, with a press release. That is not a conspiracy theory. That is recorded history. And I want you to really feel the weight of that, because the lesson is not governments are dumb. The lesson is far more useful to you than that. The lesson is that sophistication, credentials, and confidence do not protect you from selling the bottom. In many cases, they cause it. The sophisticated seller has committees, mandates, risk models, and a powerful need to look prudent to the people watching. And prudent in a committee almost always means selling what has been falling and buying what has been rising. It means capitulating at precisely the moment the asset is cheapest and calling that capitulation discipline. Now bring that back to your silver. Every time silver goes through one of these violent shakeouts, you get the same course. The financial media runs the obituaries. The trading desks put out the cautious notes. The tone shifts from opportunity to embarrassment, and holding silver starts to feel not brave, but foolish, like you are the last person at a party that ended hours ago. And here is what I need you to understand about who benefits from that feeling. The desks that move this market do not make their money from you holding calmly for 10 years. They make it from churn, from you buying high in excitement and selling low in fear. A frightened retiree dumping metal into a dip is not a victim of the market. He is the product. He is the paying customer. And the silence about that is not an accident. It is the business model. So let me pull the thread the establishment would rather you never pulled. Why does the sophisticated seller keep marking the low? Because the things that drive them to sell have nothing to do with what the metal is actually worth. In 2011, the exchanges raised the cost of holding a silver position several times in quick succession. Silver fell roughly 30% in a matter of days. Now listen closely, because this is the part they gloss over. Nothing about silver itself changed in those days. Not the supply, not the demand, not a single solar panel or electrical contact. The metal was identical on the way down as it was at the top. What changed was the rules on the paper, and the paper forced the leverage to sell, and their forced selling looked, to everyone watching at home, like the market delivering a verdict on silver. It was not a verdict. It was a margin clerk. That is the machine. The most aggressive, most confident selling in these episodes is almost never a considered judgment that the metal is worthless. It is forced. It is mechanical. It is a leveraged position that has to be liquidated regardless of price, dumped into a thin market at whatever it will fetch, in the crowd, watching the screen bleed red, mistakes that force dumping for wisdom. They think the smart money is getting out. In reality, the smart money is often the one getting stopped out, and someone patient, someone unlevered, someone who owns the physical metal outright, is quietly on the other side, taking delivery. Let me pause here, because this is exactly the moment I would be failing you if I only talked history and mechanics and never told you what to actually do about it. If you are 55 or older and you have $100,000 or more sitting in a 401k or an IRA, there is something happening at the very top of the financial world that you deserve to know about, because it is the mirror image of the mistake we have been dissecting. While the sophisticated sellers were marking bottoms, the central banks, the actual central banks, have been buying gold at a pace we have not seen in generations. More than 1,000 tons a year for 3 straight years, roughly double what they were buying the decade before. They are not doing it to trade. They are doing it to protect. And here is what almost nobody tells the ordinary saver. There is a completely legal, established way for you to do the very same thing inside the retirement account you already have. You can move a portion of that 401k or IRA into physical gold and silver, real metal, without triggering taxes and without triggering penalties, through what is called a self-directed precious metals IRA. This is not some exotic loophole for insiders. If you have $100,000 or more in any retirement account, this is squarely for you. I have put together a free guide that walks through exactly how it works, step by step, in plain language. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. It costs you nothing, and it will show you how the biggest, most patient buyers on earth protect themselves and how you can use the same mechanism. Now let me come back to the story, because I want to widen it out and show you this is not one strange episode. This is the pattern, repeating. Go to 2013. The Federal Reserve did not raise rates, did not tighten, did nothing to the actual economy. It merely hinted that it might one day slow the pace of its bond buying. A hint. And gold fell roughly 28% that year on the strength of a suggestion. The sophisticated positioning unwound in a rush. The sellers piled out, and the story written at the time was that the gold bull was dead and buried. Within a few years, gold had bottomed and begun a long grind back toward new all-time records. The confident sellers of that hint marked another low. And you do not have to go back years to see the same machinery running. This most recent shakeout in silver had a familiar trigger. The market had leaned itself in one direction, expecting an easier, gentler central bank under its new chairman. Instead, the tone came out harder than expected, more worried about inflation than the crowd had bet on, and that single surprise was enough to knock the leverage loose and send silver into a deep, sharp correction back down toward the very zone it had launched from. Notice what did not change when it happened. The silver deficit did not close. The solar panels did not stop being built. The metal already dispersed and burned did not come back. A shift in tone from one man moved the paper moved the price, and the price scared the holders. The story never changes. Only the names on the press release do. Pull all of this together, and you get the purest version of the pattern. In every real panic, the thing that gets sold hardest is often the thing people trust most, because a cornered, leveraged institution reaches first for whatever it can turn into cash in a hurry. So the selling you see on the screen is not a considered verdict that the metal is worthless. It is a leveraged holder being forced to hand real metal to whoever is patient enough to take it. That is the whole trap in one sentence. The paper position gets liquidated at any price it will fetch. The crowd reads the falling number as wisdom, and the physical ounce quietly walks from the frightened to the calm. What looks like a rejection of the metal is almost always the setup that comes right before its best years. The paper can be dumped in a day. The ounce in your hand cannot. Here is the part that actually changes things, and I want you to lean in, because almost nobody connects these dots. The reason silver is even more prone to this than gold is structural, and it is the strongest argument in this entire video. Gold is hoarded. Almost every ounce ever mined still exists, sitting in vaults and rings and bars, and it can come back to market when the price is right. Silver is different. Silver gets used up. It is spread in tiny amounts across solar panels, electronics, medical devices, and once it is dispersed like that, in fractions of a gram, it is largely uneconomical to ever recover. It is gone. And the world has been running a supply deficit in silver for several years in a row now, demand outrunning new supply, the above-ground stockpiles quietly drawn down to fill the gap. So every time the sophisticated seller marks another silver bottom, every time the paper forces another shakeout, real physical metal moves from weak, frightened hands into strong, patient ones, out of a market that is already short. The paper writes the price. The physical writes the future. And those two things cannot stay divorced forever. There is a truth about human nature buried in here that the coldest financial history keeps proving. The most metal changes hands at the bottom, and it changes hands not from opinion, but from need. Picture who is actually forced to sell down there. The household that has run out of room. The fund that has hit its limit. The leveraged trader whose position has been called away from him near a generational low because he needs the cash and the moment leaves him no choice. That is where the supply comes from at the bottom. Not from cold analysis. From necessity and from fear. The seller at the bottom is almost never a happy, confident investor taking profits. He is someone who has been squeezed until he had no choice, or scared until he could not stand it any longer. And on the other side of every one of those trades is someone who did not need to sell, who could wait, who understood that the fear itself was the opportunity. Let me be honest with you now, because I am not here to sell you a fairy tale, and if I promised you this only goes up, I would be no better than the desks I have been criticizing. Silver is volatile. It can shake you violently. It has stalled near the same ceiling more than once across the decades, and it has spent long, punishing stretches going nowhere while holders wondered if they were fools. Its inflation-adjusted high from generations ago has still never been reclaimed in real terms, and there is no law that says it must be this year or next. This is a case, not a guarantee. It is not personal financial advice, because I do not know your situation. Anyone who tells you they know the exact price and the exact date is lying to you. And lying about metals is a very old profession. But precisely because it is volatile, the way you hold it matters more than whether you hold it. So here is the practical beat, the thing to actually take away. Own the metal, not a paper promise. Because the whole lesson of Brown's Bottom, and every episode like it, is that the paper rules can change on you overnight, while the physical ounce in your possession cannot be margin called or reprinted. Size your position so that no shakeout, however brutal, can ever force you to sell at the wrong moment, because the entire trap is built to force exactly that. And whatever you do, do not sell into the shakeout. The shakeout is not the market telling you the truth. It is the market taking your metal. Now, here is where I need you to be honest with yourself about where we are in this story. Right now, silver is not a mania. There is no line around the block at the coin shop. Your neighbor is not bragging about it at the barbecue. The financial media is not leading every broadcast with it. And that absence, that boredom, that quiet is exactly the tell. The smart money and the central banks already see what is happening, and they are already positioned. Gold has already quietly overtaken other major reserve assets in the vaults of the world's central banks. The people who move nations are acting. But the mainstream, the pension committees, the financial press, the advisor reading from a script, they have not caught on yet. And by the time they do, by the time silver is leading the news and your brother-in-law is asking you how to buy it, the easy part of the move will already be behind us. That is how this always works. Nobody rings a bell. Nobody sends you an invitation to get in early. By definition, being early feels lonely and a little embarrassing, which is the exact feeling you have been fighting this whole video. So let me close by circling all the way back to where we began and answering the question in the title as plainly as I can. Did everyone sell silver at the bottom again? Look honestly at the pattern. The sophisticated seller keeps marking the exact low in public with confidence, forced by paper and rules and the need to look prudent, while the patient buyer quietly takes the metal off his hands. That is not a prediction about next week. It is the shape of a story that has repeated for half a century, from a British Treasury announcing its own bottom, to a margin clerk in 2011, to a hint from the Fed, to a shift in tone from a new chairman. And the one thing every version has in common is that the crowd only understood it in the rearview mirror. You do not have to wait for the rearview mirror. If you watched this all the way to the end, you are already ahead of almost everyone else who owns this metal, and I want to reward that. For viewers with $100,000 or more in a retirement account, I am offering a free one-on-one educational web conference, no cost and no obligation, where we walk through your actual situation and how this precious metal strategy could fit it. Just mention that you watched this full video. And here is the honest why now, with no fake countdown. The moment to make a calm, clear-eyed decision about protecting your savings is exactly the moment when nothing feels urgent, when the crowd is bored and the price is quiet. Because once it is obvious, the calm is gone, and so is the cheap, reversible window. That window is open right now. If you are watching on your television, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Do not be the one who understands all of this only after the sophisticated sellers have finished handing their metal to someone patient. This time, be the patient one.